Hi everybody. In this video, we'll talk about revenue-related deferred tax liabilities. Income from selling properties on an installment basis is reported for financial reporting purposes in the year of the sale, but tax law permits installment income to be reported in the tax return in later years as the cash is received. As a consequence, a temporary difference occurs because taxable income is less than accounting income in the year of an installment sale, but higher than accounting income in later years when the installment receivable is collected. Let's look at the Kent Land Management example. Kent Land Management reported pre-tax accounting income in 2021 of $180 million, 2022 of $100 million, and in 2023 of $100 million. The 2021 income includes $80 million from an installment sale of property. However, the installment sales are reported on the tax return when collected. The company expects to receive $20 million in 2022 and the remaining $60 million in 2023. The enacted tax rate is 25% for each year. Notice that pre-tax accounting income and taxable income are the same amount over the 3-year period, but are different in each year. In 2021, taxable income is $80 million less than accounting income because it does not include income from installment sales. That temporary difference reverses over the next 2 years. In 2022 and 2023, taxable income is more than accounting income because the income from the installment sales reported in the income statement in 2021 becomes taxable during the next 2 years as installments are collected. Because tax laws permit the company to delay reporting this income as part of taxable income, the company is able to defer paying the tax on that income. As shown here, tax is not avoided, just deferred. Approaching the deferred tax liability from the income statement point of view, we calculate income tax expense by following the 4 steps. Kent's 2021 taxes payable is $25 million. That's the taxable income of $100 million times the 25% tax rate. Future taxable amounts of $80 million, taxed at 25%, will generate a deferred tax liability of $20 million. That's $80 million of deferred tax income times 25%, or $20 million deferred tax liability. Because no previous balance exists, we credit deferred tax liability for the entire $20 million to change the account balance from 0 to $20 million credit balance. That amount combines with the taxes payable of $25 million to give us an income tax expense of $45 million in year 2021. Remember that the income tax expense is the plug number. It results from the credit to income taxes payable and the debit or credit to deferred tax liability. And here's the journal entry to book the 2021 tax provision for the company. Debit income tax expense, $45 million. Credit income taxes payable, $25 million, and credit deferred tax liability, $20 million. We see here that some of the initial $80 million temporary difference reverses in 2022 as the company collected $20 million of the installment receivable and includes that amount in 2022 as taxable income. Kent's 2022 taxes payable is $30 million. That's 25% of taxable income of $120 million. Now that $20 million of the installment income has been taxed in 2022, the remaining $60 million of the temporary difference remains to be taxed later. So future taxable amounts as of the end of 2022 are $60 million. This means that a deferred tax liability of $15 million should be shown in the balance sheet. Reducing the deferred tax liability from the $20 million beginning balance to the $15 million ending balance now requires us to debit the deferred tax liability account for $5 million. Therefore, the 2022 income tax expense is $25 million. Credit income taxes payable for $30 million. Debit deferred tax liability for $5 million. That means that the debit to income tax expense must be $25 million. And here's the 2022 journal entry to book the tax provision. Debit income tax expense, $25 million. Debit deferred tax liability, $5 million. And credit income taxes payable, $30 million. We see here the completion of the process of determining income taxes from the origination of the temporary difference in 2021 through the completion of its reversal in 2023. The illustration shows us that tax expense is a combination of tax currently payable and the reduction in deferred tax liability. Kent's 2023 taxes payable is $40 million. That's the pre-tax accounting income of $100 million, plus the installment income of $60 million, times the 25% tax rate, giving us taxes currently payable of $40 million. Now the remaining $60 million of installment income is taxed in 2023. None of the temporary difference remains to be taxed later. So future taxable amounts as of the end of 2023 are zero. The deferred tax liability should be reported as zero then at the end of 2023. And that requires us to debit the deferred tax liability for $15 million. If the taxes currently payable is $40 million, offset by a $15 million debit to deferred tax liability, that means we need to debit income tax expense, $25 million. And here's the 2023 journal entry to book the tax provision. Debit tax expense, $25 million. Debit deferred tax liability, $15 million, and credit income taxes payable, $40 million. Now look at what happened to the deferred tax liability account over the life of the installment receivable. See how the $80 million of temporary difference originates in 2021 and reverses in 2022 and 2023 as that $80 million as shown as taxable income in the tax return. Let's work a concept check problem involving an installment sale. Shortly before the end of 2021, Coulter Company makes an installment sale that generates $400 of before-tax income. Coulter recognizes income for accounting purposes when the sale is made, but will recognize income for tax purposes when cash is subsequently collected in 2022. Coulter has a tax rate of 25%. As a result of this transaction, Coulter's tax expense journal entry would include A debit to deferred tax liability for $400, B, a credit to deferred tax liability for $400, C, a debit to deferred tax liability for $100, and D, a credit to deferred tax liability for $100. Please pause the video, do your calculation, select your answer, then start the video again to check your work. The correct answer is D, a credit to deferred tax liability for $100. We have a $400 book tax difference. 400 times 25% means the ending balance in the deferred tax liability must be $100. The beginning balance was 0, which means we must credit the account by $100 to bring its ending balance up to the correct $100 ending credit balance. I think it's time for a bonus point break. I'll award 5 bonus points to the first 20 students to send me a picture of a very pretty horse, no later than the due date of exam number 3, which will cover chapters 16 and 17. Do you remember the Kent land management example we worked on from an income statement perspective earlier in this video? Well, let's take a look at the very same fact pattern from the balance sheet perspective. Very same facts. Taking a balance sheet perspective, we can calculate the deferred tax liability each year by looking at the book tax difference that exists for the installment receivable. In the example we worked on earlier, we knew that the deferred tax liability needed a credit balance of $20 million at the end of 2021, and that dropped to $15 million at the end of 2022, and it dropped to 0 at the end of 2023. Therefore, we needed to debit the deferred tax liability for $5 million at 12/31/2022 and debit the deferred tax liability account for $15 million at the end of December 31st, 2023. These numbers agree with the examples that we came up with using the income statement approach. So we're doing the very same calculation, we're just looking at the balance sheet. In 2021, at the end of the year, the book value of the installment receivable was $80 million because we hadn't collected any money yet. But the tax basis was 0 because we hadn't collected any money yet and there was no taxable income for the installment sales. So the difference between the two was a temporary difference of $80 million at 25%, calculated our deferred tax liability of $20 million. During 2022, we actually received $60,000 of cash on that receivable, bringing the balance of the installment receivable down to $60,000, $60 million. The tax basis is still 0 because we received the tax and we paid the tax on the $20 million of cash received. Therefore, we have a book tax difference of $60 million times 25% equals $15 million ending balance in the deferred tax account. It had a $20 million credit balance. We had to debit the account for $5 million. And we received the rest of the cash, $60 million, in 2023, bringing the installment receivable down to 0 for accounting book value. And again, we picked up the income and paid the tax on the $60 million in the tax return, so the tax basis is also 0. Therefore, the deferred tax liability is 0 at the end of 2023. Well, that's all for this video. In our next video, we'll begin our discussion of deferred tax assets.